Today we'll talk about this guy, Harry Markowitz, or rather the portfolio theory he pioneered in 1952 that is still a cornerstone of finance.
Okay, boomer.
First, I'll quickly explain what modern portfolio theory is. Then we're going to look at some real-world implementations with actual data to see how the model works in practice and what we can learn from it. Lastly, I will share a tool I made that you can use for free that you just gotta stick around for. The link is in the description. Markowitz presents a trade-off between return and risk. And according to Markowitz, the number that best captures risk is volatility. Now, volatility is just a statistical measurement of how returns vary over time. And the concept of risk is a lot broader than that. More on that later. In this model, one assumes that a rational investor should only be concerned about these two things. Let's look at a hypothetical example. So we have two securities. Assume security A has 10% return and 20% volatility. On a graph, we would put a point around here. And then we have security B with 5% return and 10% volatility. That will be over here. If we were to combine these two securities into a portfolio, let's say for simplicity we do 50-50% on each, where would we plot our portfolio on this graph? Well, for returns it's easy. It's just the average of the two. What about the volatility? So the volatility of the portfolio will not only depend on the individual volatilities of A and B, but it will also depend on the correlation between A and B. Correlation measures to what degree two variables move up or down at the same time. If the securities don't move together, but instead move less or even in opposite direction to each other, combined they can help to smooth out the returns, helping to reduce the riskiness of the overall portfolio. So back to our theoretical example. So if the correlation is 1, then there is no diversification benefit. So the portfolio volatility is simply the average of the two volatilities of A and B. But if we allow the correlation to decrease, we can achieve lower volatility without sacrificing too much returns. For example, if correlation is 0 compared to A, we can decrease the volatility by almost half while just decreasing the return by a quarter. Allowing for even lower correlation, we can have a portfolio that has a lower volatility than either A and B. Now, this is just a theoretical example, since finding securities with these properties that's going to be stationary over time is quite rare. Now, let's introduce more securities. So what we can do is to look at possible portfolio constructions using all these securities. And for each level of volatility, we pick the portfolio that has the highest possible return. Now, if we keep doing that for different levels of volatility, we can construct a line that looks a bit like this. Any portfolio that does not lie on this line, we say is inefficient, since you can adjust the weights such that the portfolio has a higher return while keeping the volatility the same. So we call this line the efficient frontier. So which portfolio on the efficient frontier should we pick then? Well, in this simplified model, it will depend on your risk preference. For different levels of risk preference, we can construct a portfolio that lies on the efficient frontier. An extension of this model is when we introduce the ability to borrow and lend money at a risk-free rate. So in practice, the level for which you can lend and borrow is different and it's not risk-free, but this is again just a simplified model. Assume a level of risk-free rate. If the market is in so-called equilibrium, the optimal portfolio would lie at this point here, where the line starting from the level of risk-free rate touches the efficient frontier. An investor can apply different levels of leverage applied to this particular portfolio to achieve a better risk-return trade-off. Also, this portfolio has the highest risk-adjusted return in excess of the risk-free rate, also known as the Sharpe ratio. Enough theory. Let's put on our wannabe quant hats and see how this could have been applied in the real world. We will look historically from the 70s to today. We're going to construct a portfolio of US stocks, US government bonds, and gold and see how this framework could have been used. So before I press play on this simulation, I'm just going to explain what we see here, right? We see gold in yellow, US stock market in red, and US treasuries in green. And then we have the returns and the volatility and the time axis. The first point in time we have is 1979. That means that we are standing at 1979 and we'll look back 5 years for our data. Yeah, so I will press play here in simulation. Now I'm going to have my live reaction to my own simulation, kind of, right? Which is not pathetic at all. First, we see that gold is outperforming most assets. That is later followed by a big drawdown. It takes quite a while to recover. The stock market is doing a lot better together with US treasuries, but then, whoops, we got the dot-com bubble, but then we are so back, but then we got the financial crisis, but then we followed by a recovery in the stock market, and eventually some gold recovery as well. Now we're going to run the same simulation, but we will plot the efficient frontier. So it's interesting to see how the efficient frontier changes dynamically as the return and volatilities changes for all these asset classes. And finally, on the efficient frontier, we will also plot the max Sharpe ratio portfolio, like the most efficient portfolio, as well as the allocation split between the three assets. And you can clearly see like the allocation switches quite rapidly dependent on the return and the volatilities of the best asset classes at the time. It really changes a lot. It really feels like everything
everywhere is always moving, forever. Get used to it.
Well, the fact is 5 years is not that long. So it makes more sense to look at the very, very long term. Here's the efficient frontier we get when we're looking at from the 70s to today. Now, there's plenty of critique that is worth bringing up for this model. Outputs are quite sensitive to the inputs. Past returns is not a good indicator of future returns, of course. So in our simulations, we just use historical returns for illustration purposes. Not only are returns the most difficult input to estimate, but the optimization is also most sensitive to returns. Meaning if you are wrong on your return estimation, it will have a greater impact on the model than if you were wrong about either the volatility or the correlation. Now, being sensitive to inputs is not unique to this model. Instead, it's quite common for other optimization tasks that uses inputs that are forward-looking forecasts. So there's always a sensitivity to the inputs here. Also, allocations tends to be highly concentrated. So the optimization tends to create portfolios that only allocates to a small subset of the investment universe that you provide. We kind of saw this in our simulations as well. So how to get around this? Well, the model is quite flexible, so you can add your own constraints to certain asset classes, or like, for example, maximum weight of a certain sector, or letting one asset class be within a certain range. You can look at other models like the Black-Litterman model that uses techniques to make the portfolio for the optimization more diversified. And as mentioned before, risk is a broad concept and it's not fully captured in volatility. A good way to illustrate this is the following. So here we have a plot of the monthly returns of the Vanguard S&P 500 index fund from 2023. And it's coupled with a hypothetical portfolio that completely replicates this. So what we're going to do now is that we're going to assume on June that the red portfolio has twice the monthly return of the S&P 500. And what we can see here is that the volatility is actually increasing, but I would not say that the risk of the red portfolio has increased, right? Quite the opposite. It offers more upside return. Why would it be more risky? So ways around this is to use slightly different risk measures. You can use what's called downside volatility that only takes into account negative returns. So high positive returns that we saw before will have no impact on the volatility. And you can also look at other risk measures like value at risk, for example. Okay, so finally, you're going to ask me, is this really useful? So I would strongly say yes, right? It is just a model, and with any model you have to know its limitations, and it's not going to solve every problem you have, right? I think you should just see it as another tool in your toolbox that you can use. Now, if you've been here for this long, I will give you a little gift. So I made a tool here on Google Sheets. In the first column here, this is our portfolio, and we can input various stocks that we want to analyze. Let's say we put in Apple, we put in Goldman Sachs, we put in McDonald's. We can also create like hypothetical portfolios. Let's say we go 50% Apple, 50% Goldman Sachs, and our portfolio will be here, right, based on our allocation. So we're gonna estimate the historical returns and historical volatilities, and we're gonna take into correlation over here. And you can also input your own estimation for return and volatility, so you don't have to stick to the historical values. And this works great for foreign stocks as well. Let's say we go to China, and first we have to import the ticker for the exchange, so HKG, and then we can do Tencent, for example. All right, it's going to give us something like this. So this is quite useful. In the description, I will leave a link to this Google Sheet for you to copy. If you want to do this type of analysis without this tool, I would recommend the website Portfolio Visualizer, link in the description. For individual stocks, I think it only works for US stocks, so that's why I made this tool. Thank you so much for watching. See you next time.